How does a company that, makes physical objects out of foam and suede and leather and then ships them across the ocean in these giant metal boxes suddenly start posting profit margins that look like they belong to a Silicon Valley software company?
Yeah, it's a great question, especially in a retail environment that has just been, well, incredibly punishing for the last several quarters.
Right, totally. Today, we are cracking open the Q4 and full year fiscal 2026 earnings call transcript for Deckers Outdoor Corporation. For those of you tracking the ticker, that is DECK.
And if the corporate holding company name doesn't immediately ring a bell for you, their two flagship assets absolutely will. We're talking about UGG and HOKA.
Welcome, everyone, to a special Talk Tickers edition of The Deep Dive. We've got the earnings transcript, the supplemental press releases, and the historical models all stacked up to figure out exactly what is happening inside this company.
Because honestly, it is a remarkable set of documents.
Yeah.
We've been seeing heavy discounting, bloated inventories, and just general consumer spending exhaustion everywhere else.
Exactly.
But Deckers is operating in what looks like, an entirely different macroeconomic reality.
Okay, let's unpack this. Our mission today is highly specific, and it's tailored for you, the retail investor. We are going to provide a data-forward, highly opinionated, and actionable analysis of this earnings call.
Right, and we're skipping the elementary definitions today. We know you already understand the mechanics of the market, so we're going straight into the architecture of their success.
Yeah, we've got a format structured around four main areas. We're looking at the headline numbers, the strategic brand execution, the management guidance against these current macro headwinds, and finally, the bottom line regarding their capital allocation.
And we are really going to scrutinize the operational levers management is pulling here. Because, an earnings print this strong doesn't just happen through sheer brand momentum.
No, definitely not.
It requires some surgical precision in supply chain management and channel strategy.
So let's start by ripping into the core data. For the full fiscal year 2026, Deckers reported a record $5.47 billion in top-line revenue.
Which is just a massive baseline.
It is. That's a 10% increase year over year. And narrowing in on just their fourth quarter, revenue came in at $1.12 billion, which again also tracks at a 10% year-over-year growth rate.
Over $1 billion in a single Q4.
Right. And historically, post-holiday, Q4 is a period where footwear and apparel companies usually brace for a severe deceleration.
Yeah, and sustaining double-digit top-line growth at a $5.5 billion scale, that is where you start separating the fleeting pandemic darlings from the durable compounders.
Because the law of large numbers dictates that growth should naturally decelerate as the revenue base gets bigger.
Exactly. To maintain 10% on that massive denominator implies they're actively taking significant market share from legacy competitors. They aren't just growing with the market.
Now, the earnings per share data is where the narrative requires a bit of parsing. Full-year diluted EPS hit $7.02, which is an 11% increase.
But the Q4 specifically was a bit of a miss, right?
Yeah. Q4 EPS was 96 cents, which actually represents a slight compression compared to the flat $1 they posted in the prior year period. But reading through the transcript, management didn't shy away from this at all.
No, they didn't. They explicitly stated they strategically shifted some expenses into Q4.
Right, to accelerate top-of-funnel marketing and tech investments, basically establishing a stronger foundation for the next fiscal year.
Which is such a flex, honestly. Pulling expenses forward into a current quarter is a classic maneuver for a management team that is just operating from a position of absolute fortress strength.
Yeah, cause weak companies try to capitalize expenses or defer maintenance to artificially inflate the current quarter.
Exactly, because they're terrified of missing Wall Street consensus.
Right.
But when a company is already crushing its full-year targets, they have the luxury of absorbing a hit in Q4 to pre-fund customer acquisition for the next cycle.
And it completely shields them from accusations of underinvesting in the brand to juice short-term margins. But speaking of margins, this brings me to the data point that completely recontextualized my view of the stock.
Gross margin numbers.
Yes. Operating margins hit a best-in-class 23.1% for the year, and their Q4 gross margin specifically expanded by 90 basis points to hit 57.6%.
That is just wild for a physical product.
I really want to dig into the mechanics of this because generating a nearly 60% gross margin on a consumer discretionary good is absurd. They aren't selling digital subscriptions, they're making shoes. So how are they pulling this off?
Well, what's fascinating here is the operational discipline enforcing that 57.6% gross margin. Yeah. It is the direct financial manifestation of three words, and those are full price selling.
Full price selling.
Right. In the apparel sector, the traditional wholesale model is structurally reliant on promotional cadence. A brand overproduces, the wholesale channel gets choked up with excess inventory.
And then the only way to clear the channel is just aggressive markdowns.
Exactly. Every time a retailer slaps a 30% off sticker on a shoebox, the manufacturer's gross margin compresses. Deckers has functionally engineered the clearance rack out of their business model.
I want to push back on that slightly, or at least challenge the sustainability of it, because engineering the clearance rack out implies they possess some flawless predictive inventory algorithm, which, doesn't exist.
Fair point.
How are they actually managing to match supply so perfectly with demand that the consumer is just forced to pay full price? We've seen brands claim this before, and they cave the second inventory builds up.
Yeah, the sustainability of it comes down to intentional allocation restriction. Management isn't trying to perfectly predict demand. They are actively choosing to undersupply the market relative to that demand.
Oh, so they're intentionally leaving revenue on the table.
Exactly. If they project demand for a specific HOKA colorway at 100,000 units, they might only produce and allocate 85,000. By running this incredibly lean inventory model, they create a perpetual environment of scarcity.
That reminds me of the real estate developer strategy. A smart developer doesn't flood a new neighborhood with 500 houses all at once, which would just crash the localized housing values.
Right, they build in phases.
Yeah, deliberate phases, keeping inventory artificially tight. It forces buyers into bidding wars and keeps the price elevated. Deckers is applying that exact scarcity principle to mass market footwear. You want the new HOK Clifton, you pay $160 today or your size is gone tomorrow.
And that consumer behavior conditioning is incredibly powerful. Once a consumer learns that a brand frequently discounts, they'll just hold their capital and wait for Black Friday.
Totally. I do that all the time with other brands.
Right. But Deckers has successfully conditioned their consumer base to understand that waiting means missing out entirely. When you eliminate the expectation of a discount, the velocity of full price sales actually increases.
That 57.6% gross margin tells us their pricing power is completely intact despite massive inflationary pressures on the average consumer. So let's transition into the story behind the numbers, because pricing power doesn't just exist in a vacuum. It requires highly relevant product. UGG added $207 million in incremental revenue this year, bringing the brand's total to $2.74 billion.
Which is a massive jump.
It really is. And this is where I found the transcript most illuminating, because I have historically viewed UGG through a very narrow cyclical lens.
Like a winter utility brand.
Yeah, a Q3 and Q4 cold weather utility brand heavily indexed to a female demographic. So how are they generating nearly $3 billion and sustaining year-round growth?
Well, the earnings call provided the ultimate validation of Stefano Crotti's 365 strategy. The management team has basically systematically dismantled the cold weather dependency of the UGG brand.
Because historically, Wall Street heavily discounted their valuation multiples due to that seasonality, right?
Exactly. You cannot command a premium multiple if your flagship product sits dormant in the closet from April to September. So the 365 strategy was designed to bridge those off-season quarters.
And the product mix data they provided totally supports that structural shift. The transcript highlighted the Lowmel franchise and the Golden Collection, noting that these specific lines accounted for more than half of the brand's growth in fiscal 2026.
Yeah, and the Lowmel is essentially a chunky, skate-inspired sneaker.
Right. They are capturing growth through silhouettes that have absolutely nothing to do with sheepskin winter boots.
Building on that, the launch of the Otso clog in February was a strategic masterstroke. February is usually the tail end of winter clearance for most retailers.
But UGG just drops a transitional clog aesthetic, driving immediate global sell-through.
Exactly. They also highlighted the Tasman franchise, which is technically a slipper, but they have completely repositioned it as acceptable outdoor streetwear. They are blurring the lines between indoor comfort and outdoor utility.
Which effectively expands the usage occasions for the product, and they are capturing a completely different consumer demographic in the process. The CEO actually mentioned that men's styles accounted for over 20% of the brand's global growth this year.
That is a huge shift.
It really is. They specifically cited a North American collaboration with the menswear brand Hidden. The drop sold out rapidly, but the critical data point was that over half of the buyers were completely new to the UGG database.
Wow. And they fell squarely in the 18 to 34 age bracket, right?
Exactly.
That specific demographic acquisition changes the entire total addressable market for UGG. Collaborations with brands like Hidden, they aren't designed to generate massive immediate revenue. They're designed to generate cultural capital.
It signals to a younger male streetwear consumer that UGG is a permissible, even coveted brand to wear.
Right. And when you layer an entirely new demographic cohort on top of a highly loyal legacy female consumer base, the revenue ceiling just lifts dramatically.
I am curious about the risk of brand dilution here, though. When a heritage brand stretches its aesthetic language this far, moving from classic shearling boots into skate sneakers and streetwear clogs, don't they run the risk of alienating their core customer?
It's a real risk, yeah.
Especially while simultaneously appearing inauthentic to the new customer. We saw Under Armour try to stretch from performance compression gear into casual lifestyle footwear, and it was a strategic disaster. They lost their core identity. So why is UGG succeeding where others have failed?
Well, the difference lies in maintaining brand DNA. Under Armour failed because they abandoned their core competency of performance to chase a casual trend. UGG is succeeding because whether they make a winter boot, a sneaker, or a clog, the core DNA remains the same.
Which is that extreme, unapologetic, tactile comfort.
Exactly. They aren't trying to make a high-performance basketball shoe. They are making a highly comfortable, slightly oversized streetwear sneaker that feels aesthetically adjacent to their boots.
The brand architecture holds up because the value proposition of comfort is consistent across all the silhouettes. That makes a lot of sense.
Yeah, the tactile identity is definitely the through line.
Now, let's pivot to the absolute growth engine of the Deckers portfolio, which is HOKA. The numbers here are just staggering. For the full year, HOKA added an incremental $354 million in new revenue.
Pushing the brand total to $2.59 billion.
Right, and they noted Q4 was the largest quarter in the history of the brand.
The HOKA trajectory is a textbook study in franchise management. They're not reliant on a single hero shoe, nor are they constantly churning out unrelated product lines, hoping one catches fire.
They operate through highly structured, scalable platforms. The transcript focused heavily on the Bondi, the Clifton, and the Moffett franchises.
And that franchise strategy is fascinating because it drastically reduces R&D risk. Once you establish consumer trust with the Clifton as a daily road running shoe, the customer acquisition cost for a variation of that shoe drops to almost zero.
Because they already know the fit, they trust the midsole geometry.
Exactly. The transcript mentioned expanding the Moffett franchise to include the Moffett X for peak trail performance, the Moffett 5 is the everyday trail workhorse, and the Moffett Speed 2 geared more toward the lifestyle consumer.
They are slicing the demographic into incredibly fine segments.
And that segmentation allows them to capture a broader share of the consumer's wallet without cannibalizing their own sales. Our hardcore runner might buy the Moffett X for an ultra marathon, but they'll also buy the Speed 2 to wear it at the coffee shop.
By the end of fiscal 2026, Deckers reported having 6 different HOK franchise families generating over $100 million of annual revenue each, 6 distinct $100 million pillars.
That is incredible structural stability.
Right. If the maximalist trail running trend cools off slightly, they have 5 other massive revenue streams to absorb the impact. But what really jumped out at me regarding HOK's growth was the channel execution.
The DTC numbers.
Yes, the management team highlighted an 18% jump in HOK's direct-to-consumer, or DTC, channel for the fourth quarter. Given that our audience is intimately familiar with the margin arbitrage between wholesale and DTC, an 18% growth rate there is a massive profitability lever.
Oh, absolutely. The margin capture is the obvious benefit. By bypassing the sporting goods stores and independent run shops, Deckers is retaining the entire retail markup.
Which goes straight to the bottom line.
But the secondary, and honestly arguably more vital benefit of that 18% DTC surge is zero-party data acquisition. Wholesale partners act as a firewall between the brand and the end consumer.
So Deckers doesn't know the purchase frequency, the size profile, or the color preferences of a customer buying HOKers at a big box retailer.
Right, but when that transaction happens on HOK.com or inside a Deckers' own retail store, they capture the entire behavioral profile.
Which is gold in modern retail. And Stefano Carati specifically noted the strong signups for their updated HOK membership program, which now gates early product access and exclusive colorways behind membership.
They are incentivizing the consumer to hand over their data in exchange for priority access to scarce inventory.
That database allows Deckers to run highly targeted, hyper-efficient digital marketing campaigns. They can predict lifetime value, model cohort retention, and dramatically lower their overall customer acquisition costs over time.
It's just a brilliant feedback loop.
So to synthesize the operational story here, UGG has successfully deseasonalized its cash flows through the 365 strategy and demographic expansion, while HOK is scaling a highly diversified franchise architecture and aggressive DTC channel growth.
It is an incredibly potent dual-engine model.
But this naturally leads us into pillar 3 of our analysis, which is management guidance. Because as we know, the market is a forward-looking discounting mechanism. We don't invest in yesterday's earnings.
Exactly. And this is where the earnings call introduced some necessary friction. The macroeconomic reality is intruding on their operational excellence.
Let's look at the top-line forecast for fiscal 2027. Management is projecting revenue between $5.86 billion and $5.91 billion.
That implies high single-digit consolidated growth, with HOK expected to grow in the low double digits and UG moderating to mid-single digits.
And earnings per share are guided to a range of 7.30 to 7.45. So top line is expanding, bottom line is expanding. But then we hit the gross margin guidance, and this is where I need to ask, so what does this all mean?
Right, the margin compression.
Yeah. Management is forecasting gross margins to compress slightly to 56.5%, down from the 57.7% they achieved this past year. If their DTC channel is growing at 18% and their full price selling discipline is intact, the structural margins should be expanding. A projected contraction indicates significant exogenous pressure.
And Steve Fashing, the CFO, was very transparent about the specific macroeconomic headwinds driving that compression. The first major factor is higher freight costs.
The shipping disruptions.
Yeah, we are seeing severe disruptions in global shipping lanes, specifically tied to the geopolitical instability in the Middle East. The attacks on commercial vessels in the Red Sea have functionally closed the Suez Canal to a massive percentage of global freight traffic,
which forces the shipping conglomerates to reroute vessels entirely around the African continent down past the Cape of Good Hope.
Exactly. And that reroute is not just a trivial logistical adjustment. It adds anywhere from 10 to 14 days of transit time to every single shipment moving from Asian manufacturing hubs to European and North American ports.
That extra time on the water burns significantly more bunker fuel, which drives up the baseline shipping rates.
And furthermore, it creates an artificial scarcity of shipping containers because those containers are tied up on extended voyages instead of returning to port to be reloaded.
So Deckers is forced to pay elevated spot rates just to secure container capacity, and those heightened freight costs bleed directly into the cost of goods sold, compressing the gross margin. You can have the most coveted sneaker in the world, but if your logistics costs spike by 20%, the margin has to give somewhere.
The second margin headwind Fashion identified is increased input costs. But he framed it in a very specific way. He cited material upgrades alongside general inflationary pressures.
Oh, that is a critical distinction. Deckers is not just a passive victim of rising raw material costs. They are actively choosing to inject higher cost materials into their product lines.
Exactly. And this makes perfect sense given their premium positioning. If you are conditioning the consumer to pay $180 for a pair of Maffates at full MSRP, the physical product has to justify that valuation.
They're likely moving toward more expensive supercritical foams in the midsoles or higher denier-engineered meshes in the uppers.
Right. They cannot afford to value engineer the product and risk degrading the consumer experience just to protect 50 basis points of margin.
They are strategically absorbing some of the cost of those material upgrades rather than pushing further price increases onto a consumer base that is already dealing with broad macroeconomic inflation.
It's a calculated trade-off. Sacrifice a fraction of the gross margin today to protect the long-term integrity and premium perception of the brand.
The third major headwind discussed on the call is the regulatory and tax environment, specifically regarding U.S. import tariffs.
Right, the 10% tariff assumption.
The guidance assumes that the current tariff rate of 10% on U.S. goods will remain static for the entirety of fiscal 2027. But the transcript also detailed a very specific historical tariff burden where Deckers paid roughly $120 million in gross tariffs to import their inventory.
And the tariff situation requires some really aggressive accounting prudence. Decker's management actually believes they have a strong legal and regulatory case to receive a refund on a significant portion of those previously paid tariffs.
Based on specific product classifications and exemptions, right?
Yeah, exactly. However, Fashing made it explicitly clear that they are entirely excluding any potential tariff refunds from their forward guidance.
Which is exactly what you want to see from a CFO. You do not model your future EPS based on a pending government refund check. You model based on the punitive baseline.
Because if the refund materializes, it becomes pure upside surprise for the quarter in which it drops. But baking it into the guidance is a recipe for a catastrophic earnings miss if the regulatory bureaucracy stalls.
It speaks to the conservative nature of their financial modeling. Between the Red Sea shipping disruptions, the conscious choice to invest in material upgrades, and the punitive tariff environment, they have loaded their guidance with a tremendous amount of macro friction.
And the fact that they are still projecting EPS expansion to 7.45 in the face of all of that is just a testament to the sheer strength of the underlying demand model.
This naturally transitions us to Pillar 4, which is the bottom line in capital allocation. Because when a company is facing these kinds of macroeconomic squalls, the structural integrity of their balance sheet dictates whether they play offense or defense.
And Decker's balance sheet is arguably the most pristine in the entire footwear sector.
As of the end of fiscal 2026, they are sitting on $1.9 billion in cash and cash equivalents and zero outstanding borrowings.
Zero debt. During a period where the cost of capital has absolutely skyrocketed due to elevated interest rates, Decker's carries no debt drag on their earnings.
They are immune to the refinancing risks that are currently strangling heavily leveraged retail operators. I really want to emphasize the operational optionality that zero debt provides.
It's huge.
When you don't have massive quarterly debt service payments, you aren't forced to make desperate inventory decisions to generate short-term liquidity. A highly leveraged company that experiences a sudden drop in demand must liquidate inventory at clearance prices just to make their interest payments.
But Decker's can afford to hold firm on pricing, maintain their scarcity model, and let the inventory clear naturally because they aren't answering to bondholders.
That financial insulation is the bedrock of what management referred to as their pull model of demand.
In a heavily leveraged push model, the company forces product into the channel and relies on aggressive marketing and discounting to move it. Decker's operates a true pull model.
The consumer demand is pulling the inventory through the system faster than Decker's can replenish it. And the most startling data point from the entire earnings call confirms this. Despite achieving 10% top-line sales growth, their physical inventory levels actually decreased by 2% year over year.
Let me just highlight that, because that is the holy grail of working capital management. Generating double-digit sales growth while actively shrinking your inventory footprint implies an astronomical inventory turnover ratio.
They are converting raw materials into cash at an incredibly accelerated velocity. They're completely avoiding the bullwhip effect that typically plagues retail supply chains during periods of fluctuating demand.
And that extreme efficiency generates a massive river of free cash flow, which brings us to the capital allocation strategy.
Because sitting on $1.9 billion in cash is great for stability, but it is ultimately an inefficient use of capital if it isn't deployed to generate shareholder return.
Right. And Decker's has aggressively committed to returning that capital through share repurchases. During fiscal 2026, they deployed $1.075 billion to buy back their own stock in the open market.
Over $1 billion in buybacks in a single year, and the board just authorized a new, massive share repurchase program. But the specific metric Steve Fashing provided is what investors need to really key in on here.
He stated that the company expects to utilize an amount equivalent to at least 80% of their free cash flow for ongoing share repurchases.
Committing 80% of free cash flow to buybacks is a highly aggressive, highly confident signal to the market. Let's analyze why they are choosing buybacks over dividends or M&A.
Paying a massive dividend creates a permanent expectation of yield that punishes the stock if it's ever cut. And mergers and acquisitions in the retail space have a notoriously high failure rate.
Yeah, integrating different corporate cultures and supply chains usually destroys shareholder value. Building on that, when management believes their own assets, UGG and HOK, are the highest returning vehicles available, the most logical move is to simply buy more of their own company.
Exactly. By retiring those shares, they are mathematically compressing the denominator in the EPS calculation.
So even if net income were to remain completely flat, The earnings per share would increase simply because there are fewer shares outstanding laying claim to those profits.
It acts as an incredibly durable floor under the stock valuation. When the market knows that Decker's management is structurally committed to stepping in and buying with 80% of their massive free cash flow generation, it creates significant downside protection for you, the retail investor.
They are manufacturing EPS growth through both operational leverage on the top line and financial engineering on the bottom line, which perfectly aligns with the long-term strategic framework they laid out at the end of the call.
If we connect this to the bigger picture, management didn't just restrict their vision to the upcoming fiscal year. They provided an operational roadmap all the way through fiscal 2030.
They are projecting consolidated revenue to grow at a high single-digit compound annual growth rate through the end of the decade.
Driven by HOK, sustaining low double-digit annual growth, and UGG maintaining mid-single-digit growth.
But the true power of this model is revealed in the bottom line projections. Because of the anticipated margin stability and the compounding effect of the 80% free cash flow buyback program, management expects earnings per share to grow at a low double-digit rate annually from fiscal 2028 through 2030.
Revenue grows high single digits, but earnings per share grows low double digits. That delta represents the pure operational leverage of a well-run, debt-free enterprise.
It proves that the success of the last few years wasn't a pandemic anomaly. They didn't just get lucky because people bought slippers during lockdowns. They have architected a highly resilient, multi-brand growth algorithm capable of navigating significant geopolitical and macroeconomic turbulence.
If you are asking for my ultimate takeaway, it is decisively bullish. The discipline required to maintain a pull model of demand at a $5 billion scale is exceedingly rare.
When you pair that operational discipline with a zero-debt balance sheet and a management team aggressively retiring shares, you have a blueprint for sustained capital appreciation.
It's just a phenomenal setup.
As we look to wrap up this analysis, I want to leave you with a final, slightly provocative data set to consider regarding the future ceiling of this company. We've spent an hour dissecting the billions of dollars in revenue HOK is generating.
$2.59 billion in a single year.
Right. It feels ubiquitous. You see the shoes on nurses, on marathon runners, on baristas, everywhere you go. But Stefano Carati shared some brand penetration data that completely subverts that feeling of ubiquity.
The awareness metrics are truly eye-opening when you juxtapose them with the revenue figures.
Right now, unaided brand awareness for HOK sits at only 60% in the United States. And in their international markets, that awareness drops even further, averaging around 40%.
That's incredibly low for a brand doing that much volume.
And from a distribution standpoint, the brand is only 50% penetrated in U.S. sporting goods stores and a staggering less than 20% penetrated in European athletic specialty stores.
They are generating nearly $3 billion in revenue while still remaining functionally invisible to nearly half the global market.
And that is a question I want to leave you with as you evaluate your position in Deep-Hook. If HOKA is already posting record-shattering billion-dollar individual quarters without maxing out their basic retail distribution network, and with massive swaths of the domestic and international consumer base not even knowing the brand exists yet, what exactly does the ceiling look like when those awareness and penetration metrics normalize to the levels of their legacy competitors?
The runway for international wholesale expansion alone could drive growth for the next decade.
It is a mathematical reality worth modeling out on your own.
It perfectly contextualizes why management is so confident aggressively buying their own stock. They look at those penetration numbers and realize the growth curve is still in its intermediate stages.
We started this analysis talking about the rarity of finding a corporate financial structure that is entirely free of muddy execution and defensive excuses. Deckers has provided one of the cleanest, most structurally sound earnings reports in the current retail landscape.
The margins are defended by genuine scarcity, the product lines are diversifying without losing their core DNA, and the balance sheet is an absolute fortress.
Thank you all for joining us as we unpacked the data, the strategy, and the mechanics behind the numbers. We will see you on the next Talk Tickers edition of The Deep Dive.